All right. Good morning. Good morning. Other than the Chicago PMI, we really don't have much on the agenda today. There was some odd movements in the FX market in the overnight hours, which continues to be my default argument for if things are going to get a little wacky, it's more than likely going to come from that direction. Remember that most of the time when the markets make its biggest moves, it comes from when institutions and traders are on the wrong side of a trade, usually from being in a position before some unknown thing happens that causes them to suddenly be on the wrong side. It's always the unknown that gets us, right? All those talking heads on TV helping people climb the wall of worry and being fearful of all the million reasons why this market could go down. It's not the things we know that get us. We do have a rig count at 3 p.m., but after working on those rigs for 20 years, they don't change the number very much, very often. So unless something really drastic happens to shut down a lot of rigs all at once, or unless a new fleet comes online, that rig number shouldn't change by very much and should not have very much of an impact on the market. Farm prices could perhaps as a part of the whole inflation watch, but it's too late in the day anyways. It'd be, around power hour anyways, and probably not a good idea to be trading in that zone, especially on a day like today. Volume again is really light, but within the norm of what we've seen over the last week. We are right where we would normally be. So nothing really stands out there for, anything of concern. We've got a very wide day to deal with. If we think about opportunities for a trend day or, getting some good clean price action, we're still sitting inside of yesterday's range, which was still sitting inside the previous day's range, which was still sitting inside the previous day's cash open. So a whole lot of running around, and we've gone nowhere. We've done nothing. We are back to the daily pivot underneath our VWAP. And the expectation is, unless something really crazy happens, say something in the FX market that shakes the world, we probably are going to go into the close today and end the year within this box, within this range. I was having a talk with somebody yesterday about why I was in the trade so fast yesterday. You gotta remember when you're dealing with the index, S&P, NASDAQ, these days, we've seen them before, right? A day just like yesterday. This is a day that we've seen before, the entire thing, from a gap up with a really big candle, a run all the way to lunch, and then a sideways drift into the end of the day. This is not a unique day. We've seen it before. And very similar to Mahjong, if you recognize this day and you can find previous days that look just like it, you can start to identify when one of these days are unfolding, and you'll know, or you'll have a pretty good idea of the kind of day you're going to have before it even really unfolds. Now, once we got into lunch, there was kind of a branch at this point. We had, the opportunity to go down. We had an opportunity to continue the move after lunch, or we could just go sideways into the close. So, up into lunch, we knew what kind of day it was. Once we got into lunch, well, we had to wait until the other side of lunch to see, what the rest of the day was going to bring. If we had reversed and gone back down, we call that a rounded reversal. If we had continued to move into the afternoon, then it would have been a full trend day. And just going sideways into close means that we just had a trend day. The only problem with that description is that since we were inside of yesterday's price action, this doesn't count as a trend day. Think of trend day with a little trademark name behind it, right? Like Pepsi is just a soda, or Coke is just a soda, but the Coke or the Pepsi name is the trademark name. A trend day, one of my trend days, has a qualifier to it, or a distinction that says it's not a trend day if you're sitting inside of yesterday's price action. Because if you go out to a daily chart, if this candle is inside of yesterday's candle, then we didn't go anywhere. How can you trend if you do not have higher highs and lower lows, right? If you don't have a consistent thing that makes it a trend. So you can't have a trend day when you're sitting inside the previous day. And we've been sitting here for over a week. We are IX10 at this point. So that's why I was able to pull the trigger so fast yesterday. I didn't know for sure, right? We never know 100%. But if you gap up that much and then you get no wick at all, and I mean none, and it just continues to move to the upside, that first 5-minute candle closes, when the next one opens and it breaks above that first one, I'm in. It won't always work, right? Always doesn't exist in the market, but it works often enough that even if it just runs up a few more candles and dumps, the rate of change is so much in an SPX trade that even if it had just ran up another 5 or 10 points, that options contract would have made anywhere from $250 to $500 in just that little space of time before it, if it had rolled over and dumped back down. So it's worth pulling the trigger anyways, just for a shot. So kind of keep in mind that these days that we're looking at, they're not unique. We've seen them before. We will see them again. And one of the things that you want to get familiar with is their shape, their criteria, the things that make yesterday unique to itself, and how you can find old examples that look just like yesterday. The more of those days that you recognize, the better off you're going to do. Because it's not, you can't wait for indicators, RSI and MACD and stochastics to tell you that it's a trend day. You can't wait for those kind of tools. We got to take a detour for a moment so I can point out where I think this problem is, or where the shenanigans could come in. All right, at 1 o'clock in the Globex last night, that's where I have this line started. So we're basically looking at a Globex on US dollar Japan. I made that line because on a Globex chart, or on a pairs chart like this, it doesn't have a Globex. It doesn't have that shaded area that makes it easily visible. So we had this drop last night. Right around 3 o'clock in the morning, or 2:30. Massive drop to the downside, shut down at 4. And now we're getting that double bottom. Not a classic double, but still. All right, so that's US dollar Japan. Now here's US dollar China. Last night at around 3:30, maybe a little closer to 4, we had this significant breakdown. Tell me that doesn't stand out and get your attention. It should. Now this is a ratio chart, US dollar China. So when it's going up, it means the dollar's going up. And when it's going down, it means the dollar's going down. Supposed to. That's the way things work, right? Gravity exists. The sun comes up in the east. This is how things work. Except we didn't really get that big of a move in the dollar. Not compared to the equal ratio of the move that we just saw in US dollar China and US dollar Japan. So a little bit of a move in the dollar, but later. And conversely, when you see the dollar go down that much, shouldn't the S&P and the NASDAQ futures go up? They should. So why are we down? I don't have an answer to that, guys. I don't have an answer for the why are we down. I just see that there's something wrong here and things are not behaving the way that they normally would. And this should cause you concern, right? Be nimble today. If you're looking to day trade, and be prepared for shenanigans where the market just suddenly starts going somewhere for no apparent reason, or that we see the dollar move without the S&P moving in the other direction. Because this actually went down with the dollar. You see the VIX is waking up. It matches this leg down in the S&P really well. So this is where we're at this morning, and I needed to circle through that first, so you got a pretty good idea of what we're trying to deal with today. All right, we're at the weekly pivot, and we are at the daily pivot. And just like we did yesterday, we want to measure 50% of yesterday's candle. As long as we remain above that 50%, we could continue to focus on the idea that we might expand higher today. But if we break below that 50% line and close below it, say on a 15-minute, maybe on a 30-minute, I like the hourly for that kind of stuff. But either way, getting below that 50% line will kind of imply that we're going to flip bearish and we'll likely go to the lower end of this range around 3806. So it's the benchmark line in the sand for our bias. Should we be bearish and looking for a continuation move lower, or should we be bullish and looking for a continuation move higher? This is our second week inside of this box. And at this point, things aren't too extreme yet. But if we start the third week inside of here, that will begin an IX10 on a weekly. The longer we stay in a particular location, the more we build up orders on each side, above us and below us. And it just builds energy, more and more and more energy. so that when a move finally does happen, it becomes a very explosive move. We have a market maker move this morning. Now think about everything that's gone on this week. This is, I think, the first time this week that we've had a market maker move. The market makers are pricing in extraordinary volatility, more than the normal volatility. If you don't know much about this market maker move, it exists right there. Unfortunately, if something doesn't have a market maker move, then you won't see anything there at all, which I think Thinkorswim should reevaluate that and just have it set to 0 when there's nothing, but still show the MMM. And what the MMM is looking at is the front volatility versus the back volatility. And if the front is higher than the back, then it gets an MMM status. That's where it comes from. And I know that that's where it comes from, because if you go to TD Ameritrade's website called the Ticker Tape, and you read articles about the market maker move, they will explain all about it in really good detail. Right, it's 24 points added to the 31 points that we already have for the expiring day, right? Because if you look at today, a 0 day, obviously, it's got a 31.6 expected move. We add this 31.6 to the 24.02, which means for the day, we have a 55-point move, potential move. It's not saying that we're going to make that move. It would say we could move 25 points and it would not even be considered unusual. Now, here's my argument, and it's why I built this other indicator. The average daily range right now is 78 points. Volatility says we could move 50, 55. My tool says 78 points wouldn't even be big. It wouldn't be an outlier. It wouldn't even be a wow factor. That would just be, yeah, it's another day we moved about 78 points. So what we want to do is take this 78 points and add in 23 more points from the market maker move, and just use some rounding math and say we could move 100 points today and it wouldn't even be considered an outlier. That wouldn't even be a big day. It'd just be another day at the office. From that 100-point move, we could extrapolate and start asking, well, what would violent look like? Around 3%. I didn't pull that number out of thin air either. The S&P likes to expand to round numbers, 2%, 2.5%, 3%. If you look back at how many times this year we made a 3% move, and we might have closed on the day at 2.97%, but we went to 3% first and then faded off a little. So an outlier today would be a 3% move from the close. A normal day would be anything less than 3%, say a 2.5% move, or in this case, what it's telling us is a 2.6% move. We continue to see tech versus finance. It's not supposed to be tech versus finance. It's supposed to be tech and finance, or tech or finance, but not tech versus finance. The distinction might seem a little vague, like it doesn't matter, but there's 3 risk-on sectors. If we're going to have a bullish day, we need at least one of those sectors to participate. The dominant ones are finance and tech, and what I call a filler or an assistant risk on would be consumer discretionary. So if you have finance and consumer discretionary, you're good. If you have tech and consumer discretionary, you're good. If you have tech, finance, and consumer discretionary, you're gold. But what we've seen a lot lately is tech versus finance, where you get one moving, that one stops, then the other one moves, that one stops, and then the other one moves, or even worse than that, one going in one direction and the other one going in the other direction. Both of these ended the day near their highs. So, they did get on board eventually, but by then it was too late. We were getting finance headed to the downside while we still had tech moving to the upside. There was a dichotomy between these two. If they sync up, the moves that we're likely to see are going to increase substantially. And if you look at the advancing versus the declining issues yesterday, we were maxed out. We had 101 names moving to the upside in the S&P 100. And we had 101 names in the NASDAQ moving to the upside yesterday. Every single name in the NASDAQ 100 and in the S&P 100 were all moving up at the same time, which is awesome. It's a high correlation coefficient. That's the kind of day where you don't even have to bother being a stock picker. You don't have to go in and run scans and try to decide, do you want to trade Meta or do you want to trade Facebook? Because they're all going to do the same thing. The only difference is going to be their beta. How much is one going to move versus the other one? It's on those kind of days that we would generally activate the alpha protocol. The alpha protocol is where we act like an algo and we buy a basket of stock options. We don't get to activate alpha protocol very often because we don't get that high of a correlation coefficient very often. The risk is when everything syncs up like that, the market can make some very extreme moves. So here's where things start to fall apart again. How can we have a high correlation coefficient with 101 names all moving in the same direction all at once and still have divergence between these two? Now, I mentioned earlier in the week that our tools are not going to be very effective in a shortened holiday week at the end of the year with low volumes. And maybe some of that is a part of the issue. Maybe. I'm just going to continue to stress, be cautious, be careful, and be ready for an outlier event. $10-day, 30-minute volume profile. I mentioned yesterday that this thing was going to shrink, and it doesn't feel like it shrunk that much. But as we work through the morning session today, each new candle here on the right will subtract a candle from back here on the left, right? That's the way it works. Every new print on one end takes another old print off. So as we work through the day, these candles are going to come off. And as it does, any of that volume that's registered up there is also going to come off. And we're going to see these profiles really start to shrink. Why it matters is when it comes to a volume profile or a TPO, they have classic shapes. So you've got your lowercase b. That's what we have right now. As we lose the stem on that, we're going to end up with a capital D. You can also, end up with two lumps for a B, and you can get a P. So right now we're still in the classic B, and we're about to go to a capital D unless we break to the upside or to the downside. And we leave this box because this is going to be the size of the new profile Monday, unless we leave this range as a very narrow profile. A 10-day profile, no less, right? Because this is a 10-day, 30-minute chart. what ends up happening when you have a very narrow range like this is the way that the algos have to respond when we leave this box. It's one of the reasons that I focus on these boxes all the time. They don't have a choice. A lot of these firms build options trades, which have a fluid delta. And then to hedge that position, they trade in the ES futures because it has a hard delta. So if we break outside the box to the downside, they need to get back to delta neutral to eliminate their risk. And they will sell into selling. So the more we fall, the more ES futures they will sell to get back to delta neutral in their options position. Well, if they're selling the market, it's going to go down. So their own actions are forcing the market lower. And of course, the more we fall, the more they have to sell. The more they sell, the more we fall. The more we fall, they have to sell. It creates a feedback loop. Same thing with an upside breakout. If we break to the upside, they have to buy into buying. Now, it's not immediate. As soon as we, move just 1 point outside the box, they don't just pounce on it and start buying or start to sell. There's levels that they have to get through. The math can get a little fun, but Spot Gamma does a really good job of laying out what the market makers' levels are. And they're basing it. Well, I don't want to misspeak, so I'm not going to say what they base it on. I'll say what I think they're basing it on. That way, if I'm wrong, hey, I'll take it. I've been wrong before. A lot of where that information comes from on the range that Spot Gamma is using comes from within the options chain itself. The options volatility, open interest, and volume within the options chain that gives them that range. And since it's volatility, it probably also has a square root of time formula built in there. And it gives this daily level or daily range. This day here had a spot gamma of 1.29% range. And after bottoming out and it turned around, once it stabilized, they ran it back towards that range because they were outside the range, 100%. It stalled right around in here. And when it finally broke, that was like the edge of the range right there. Then they sold into selling and ran it. And they ended up flipping it over and running it back the other direction. This is why when we move really far in a single day, you often get these V bottom reversals midday. It's because the market makers stood back, let the market do whatever it was going to do, hedged into the move. And then once everything begins to calm down, they just go in and push it right back in the direction that they needed it to go in the first place and get back into delta neutral positions. They don't fight the tide. We have an untouched point of control over our head this morning from yesterday. If we make a move up and tag that, it's very likely going to provide a first touch play or for maybe, 7 to 10 points, but that is not a support or resistance level. The same thing with the one down here at 37.90. These are not support levels. You don't lean on them like a handrail. Don't trust them to hold anything because that's not what they're for. But they're very likely going to be a place where price responds to a pivot point. So it's worth keeping an eye on where we're at. Plus, if we start to get close to them, they end up usually becoming gravity points and self-fulfilling prophecy. We go there anyways. So 38.75. Now, how close would we have to get before it becomes self-fulfilling? Well, I mean, that's a little arbitrary, but in this case today, I would say if we break back above the highest of the Globex that we have right now, we're almost destined or guaranteed to go there. That's a 5-point move, by the way. And 5 points may not sound like much, but if I got a high conviction trade and I come in with, say, 10 contracts, 5 points, 10 contracts, I like that math. So we don't need big moves in the market. We just need big conviction. This was the expected move for the week. And after all that running around, yesterday we closed basically where we ended the day on Friday last week. So now here we are Friday morning. We're down a little bit on the day. 37.90 is the low of the expected move for this week. And look at the size of next week's box. They expanded the volatility for next week. Anything in particular happening next week that requires such an expansion in volatility? I don't think I have an answer to that. We're 0.63% below the 10-day moving average, so we're still relatively close to the 10, which means we have the capacity to make big moves right now. We're not overbought. We're not oversold. We're very close to the center of the basketball court. Here's the 10-week. We're 1.3% below the 10-week. Again, really close to the center of the court, not overbought, not oversold. We have the capacity to make really big moves, and it wouldn't be extreme at all. We don't want to outrun that 10 too far, because that's when we start to pause, consolidate, potentially flip. K-Web is up. Natural gas is up. Semiconductors, tech, emerging markets, the S&Ps, energy. And bonds, which reminds me yesterday that we had started to lose bonds. We'll just replace the NASDAQ for a minute. So right now we're looking at the S&P from yesterday versus bonds yesterday. And you can see how bonds were front running everything. We lost the bonds first, and then the S&P started falling down after it. There were times yesterday where bonds and stock and the dollar were all moving in the same direction at the same time. Again, like, it's not supposed to do that. It's not supposed to move like that. So just be careful this morning. Watch those FX markets close. All right, 34% of the NASDAQ is down right now, 0.5%. 17% of the NASDAQ is down more than 1% this morning. And names on that list are our big ones: Google, NVIDIA, Facebook, Tesla. Those are part of the FANG crowd. We've also got some China names, JD and PDD. Those are two really big China names. Rivian and Tesla. And then the odd duck out right now, Netflix continues to kind of do its own thing and doesn't care what the rest of the FANGs are doing. So it's mega market cap mixed with semiconductors, some China names, and then Tesla. I'm going to round up and say 30% of the S&P is down 0.5% this morning. Including Microsoft, Google, Facebook, Netflix, Amazon. Those are the monsters. NVIDIA, Apple, Tesla, it's all of them. So you can monitor all of those with a ticker symbol NYFANG, which we usually refer to as, a tech ETF, but it really isn't tech. It's just mega market cap. And then a lot of chip names, and there's the financials. The NASDAQ 100 doesn't have financials. So when we're looking for a little divergence between these two indices, the financials stand out on the S&P. But usually it's easier for some people to see it this way. Watch lists tend to be something that newer traders struggle with. Yeah, 90's close enough. So what I did here is it won't let me choose the S&P 100. That's not even a choice. But I only want 100 names to look at. So we adjust it from the S&P 500 and try to get it as close as we can to 100 names using market cap as the filter. And then, since it was a lot of gray area, I adjusted this color scheme to be more responsive. JP Morgan, Bank of America, and Wells Fargo all down equally, about 0.5%. All right, well, Wells Fargo's being the odd one out. Looks like the credit cards are basically flat. Let's flip this around. NASDAQ 100. We don't need a filter because it's already 100 names. We just use the multiplier to make the color scheme more responsive. The size of the box gives you an indication of the market cap. So the monsters of tech really stand out, even though, like Tesla's not tech, but it's what we call it, right? Chip names are just getting eaten up this morning. And some of the names that have been running inverse of the market, like Netflix, even those are down this morning. So a lot of correlation this morning. downward instead of upward like yesterday. I took a short in XLF yesterday. The options were just really cheap. I still believe that finance and energy on an intraday basis offer some of the best liquidity and trading opportunities. These three at the top, Wells Fargo, Bank of America, JP Morgan, they tend to run in sync. So if one begins to front run, the other two more often than not will follow. Look for the one that's standing out and see if it's an outlier that's leading or if it's standing out because it just hasn't yet made the move to get caught up with the other two. Same thing with Morgan Stanley, Goldman Sachs, and Citigroup. These three down below very often have exact moves. And if one breaks ahead of the group, the other two will follow. Well, it's a nice little heads up, right? When one begins to break down, say gets a rejection off the high a day, and the other one hasn't yet done it, you're primed for a trade right there. Some markets will close early today, so be prepared for that. I believe the bond market closes early today. Yeah, bond market closes early. No, markets are not open Monday. I say that because I'm pretty sure that's what I read, but now I'm second guessing it. I will post it. Let's do it that way. I'm going to go back and look and make sure, and then I'll post it. Between now and then, Thinkorswim might post it as well, and so will a lot of other brokers. They might send you an email about updated trading schedules. I know Tradeovate does that, but Thinkorswim will send you a message, usually near the open, mentioning adjusted trading hours and trading schedule. So let me hold off on my answer and say, I'll just say I don't know, and I'll post it later on. I'm pretty sure it's closed, but I don't want to be kind of sort of sure. I want to know. Yeah. Yeah. And that's why I want to know for sure. Um, for those who can't see the chat, the discussion is holding puts through a 3-day weekend when you're long, right? Options in general doesn't even have to be puts. Holding long options through the weekend, an extra day, that theta decay is just eating you up. So, kind of want to know for sure before the end of the day today whether or not it's going to be a 3-day weekend. And someone else just mentioned that January 3rd is the first scheduled day in the options market on SPY, and SPY has options every single day of the week. Therefore, we can kind of assume that as we get into January, Tuesday the 3rd is the first day of the trading year because Monday is closed. So I like it. That's some good back and forth right there that solved that and answered the question. I was going to go dig through the holiday schedule and sure, we can do that, but this works just as good. There's no options there. They're not open. So nope, we're closed on Monday. All right, we've definitely lost the bonds. They're kind of leading us lower this morning. Microsoft is still holding out better than its peers, but not by much. Everything's pretty much riding with this same setup at the moment. This kind of double bottom setup where we're going to retest this zone or this range. When it comes to seasonality, I'm growing into becoming more and more of a fan, but we're in a bear market. So seasonality looks at all history equally, and bear markets make up only a fraction of our history, right? Most of the time, the market's not in a bear market. So bear markets don't get very much weight in seasonality, and that should cause you to proceed with caution. It is true that the first day of the year and even the first month kind of sets the tone for the year. However, that's in normal years, and we're not in a normal year. So tippy toe, right? Walk softly, carry a big stick. Proceed with caution. We might start to see a continuation in Costco, looking at how weak it is compared to a lot of its peers. The options in here are kind of trash. for a day trade or for a very small short duration trade. But if you back away a little bit more, say aiming for April, then they're not as bad as anything else. I mean, that's not very gentle, but see some open interest. Yeah, there's nobody home. All right, never mind. It's got a nice setup, but there's just not enough liquidity. Even March, which is what I've been using for, through most of December, we've been using March. It's time to move into April and June in a lot of names, but there's just not enough liquidity. So it doesn't matter what the chart is. So it looks like that Busby failed on Walmart. You got to kind of be careful here because you don't want to diddle in the middle. We're not at the high of this range. We're not at the low of this range. Right, so Caterpillar is setting up for an evening star reversal. All of the star patterns come from the idea that the market gapped first. So a morning star is down on the bottom and an evening star is up at the top. It's not confirmed until the next candle. So like down here, it's kind of hard to see that there was any gap at all, but it gapped down. That kind of got our attention. And then the next week, it gapped up and continued to go, which made that a morning star at that point. But we needed this candle to close or at least open and begin moving in the right direction for us to consider that that really was a morning star and that we were getting the follow through. Well, now we've kind of got the same thing. And it's not much of a gap. I mean, I'm not giving it, very much credit here. It's not much of a gap. But if we close this week with it still gapped up like that, then it does count as an evening star reversal. And what we're going to be wanting to watch for in the first week of the new year is a beginning move to the downside. That evening star reversal is what was the signal that the trend was dead in every one of these monsters of tech. It's right there in Apple. Right there in Microsoft. Right here in Amazon. We can go down the list. It's there on every one of them. Caterpillar is sitting right up at the tippity top. It doesn't get any better than that when you're thinking about a place to go short. This is also what they call an LRE, low risk entry. It's where you add the phrase, this is the point where you could take a trade and you could risk the least amount of money. Since the idea is if you're going to try to go short, price should not go higher than that evening star's high. It's really as simple as that. So an LRE is only good for people who manage their money well. If you suck at money management, LREs are a bad idea because it's not a low risk entry for you. You're not managing your money good. It's going to end up costing you significantly if you lose and all trades could lose. So if you don't have good money management, perhaps wait for the continuation, let it break below 225 and then join in on the move at that point. Otherwise, if we open next week inside of this candle's week, the 1219 candle, and we begin moving down, you could wait for the end of the week to confirm the evening star reversal, or you could just jump in early. Because if you can get in as close to 245 as possible, then it's the lowest risk that you could take. Now, I don't know it's going to turn here. It's a strong market that's riding up against its 52-week highs. And shorting something that's strong is not generally considered a good idea. But that is an LRE based on an evening star reversal that next week will be confirmed or not. So it's something to look forward to in Caterpillar. Campbell's Soup last week was an LRE and an evening star reversal. I know it doesn't look like much of a gap, and it's not much of a gap. It's a tiny little thing. But at the end of this week, today, at the end of the day, that evening star will be confirmed because this week's candle began to play out the way it was supposed to. This is what we think Caterpillar is going to look like next week, right? This is like a perfect example of what we're expecting. I like Campbell's better because it actually ran up and then rolled over. Whereas in Caterpillar, it's just there already, right? It's sideways. And then it has this gap up, more of like an IX10 failure. Only it hasn't failed yet. It's got to get back inside the box to be a failure. So CPB, evening star reversal. Just be cautious here. Shorting something that's strong is not often considered wise, right? Things that are strong tend to stay strong, and things that are weak tends to stay weak. It's kind of like that things in motion tend to stay in motion argument. But all things change direction at some point. Trends end. And even if this is just a pullback to $52 is a nice move. You know, it's about a $4, $4.50 move. Get a nice counter trend trade in an otherwise strong uptrending market. I know Campbell's isn't as glamorous and exciting and sexy as, you know, NVIDIA and Tesla and all of those, but it has a setup. It has something that we can lean on. Netflix recovered this week after bouncing on the lows. We might get another opportunity. The thing is, if you look at this, it looks like everything else. And I make the argument all the time with people. If Netflix and SPY both look exactly alike, why trade Netflix? SPY's got better options. Now, Netflix might have a bigger beta. It might move farther on a one-day move than SPY, which might make it a better candidate. But liquidity-wise, if it looks like SPY, trade SPY. it's more liquid, especially if you're going to day trade or take a very short duration trade, because this is one of the very few markets you can market order into and not feel bad about it. You'll never miss the move. You don't have to put in a limit order and struggle for fair pricing. You can just market order in and market order out. And the slippage is minimal. As opposed to something like Netflix, which has a 25-cent bid-ask slippage. And even if you try to land in the middle, you're still slipping 12 pennies. You could just straight up market order into SPY in and out and not slip 12 pennies. And with Netflix, it's 12 to get in, at least 12 to get out. Goodness knows how much more, right? And you're more likely to market order exit, because when the time comes to get out, most people are wanting out right this second, right now. They just market order to get the heck out. The diamonds still have a lot more room to fall, which makes them a better choice for a swing, right? If you don't want to swing from the lows and you're not catching any of these markets at their highs, the one that has the greatest room to fall usually is going to be a better candidate for the short. But the Dow is not necessarily famous for, liquidity. It's okay, but not a shining example. And it doesn't have 5 expirations a week like SPY and the Qs do. All right, so everybody have a good morning. Have a good holiday. I'll see you all next year. Be safe. Watch the clock today. It's going to be really important, and keep your eye on the FX markets.